Nothing surprising at all in what we heard yesterday. Two key points that really stood out for me in particular were the fact that they're not even thinking about a liquidity pullback or rate normalization regime. This is going to be lower for longer and longer and longer. And that was made very clear. The Fed put in the market will continue to bolster risky assets. The Fed was very clear in that indication that pullback is not going to occur until at least December 31st and perhaps even beyond. So we continue to have this juxtaposition between what the real economy is doing and what risky assets are doing. And valuations continue to go north, but the economy continues to be weak, as evidenced by all indicators, including consumer confidence recently.
Sunaina, good morning. And to your point about the Fed put remaining in place for the foreseeable future, I mean, so long as rates remain where they are and it's difficult to find yield anywhere in the world, doesn't that suggest that valuations can just continue to climb in equity markets?
That's it, and that's the continuous tension we're going to see. We're going to continuously look at our screens on CNBC and others and say, oh my goodness, look where the markets are going. And that's all markets for yield-chasing assets. Equities, commodities, private equity, private debt, all risky asset classes will continue to ride up because of the chase for yield. You have $15 trillion worth of bonds across the world trading at negative interest yields. That Fed put in the bond market will continuously chase investors into equities and others.
There's a problem, though, isn't there, for the bond markets here, and they've got to watch the money supply closely, and they've got to watch the circulation of that money, because there are those at the moment who do think we might see inflation re-emerge in 2021. Wouldn't be a good story for the bond market, although it might be more positive for equities. What's your take on these inflationary trends?
Well, the debasement of currency risk and that inflation risk is playing out as we speak in the commodities market, especially gold and silver. When you look at the entire gold market, it's around $10 trillion of gold above ground that's held by investors. And you compare that just to the market cap of Apple or what are the FANG stocks, it's absolutely way out of whack. What I'm trying to say with that picture is there's a lot of demand for commodities and golds that's about to come because of the debasement risk of currency and the upside risk in inflation. Over time, oil and equities will also be a good hedge to inflation, but in the short term, if you're worried about the devaluation of currencies, if you're worried about the fiat regime in general because of all of this QE, you are a buyer of gold and silver.